Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we're building off an episode that we did a few weeks ago where we introduced the idea of alternative investments or alternative strategies and really talked about the innovation that this is bringing to the ETF market. And today we're going to be diving in deeper to what's known as a long-short strategy in particular, which really looks to capitalize on potential market inefficiencies. And it has the potential to perform in both rising and falling environments. It can be looked at as a hedge to market volatility. And we're really going to introduce this concept and look at how this strategy works and who this might be a good solution for. Before we do get started, a quick reminder, we're not providing investment advice or recommendations. Today is all about information and education, as always. Joining me today, I have Erica Toth, Director on our ETF distribution team. Erica and I have worked together for almost a decade now. And Lou Lin, Managing Director and Head of Quantitative Investments for BMO. So Lou is actually the lead on the team that manages our long-short solutions. So I can't imagine a better person to be on today. So Erica, Lou, thanks so much for joining me today.
Thank you for having me. And Erin, I think it's been over a decade now. I think it's 11 years that we've worked together.
Yes, that sounds about right. Yep, we're aging ourselves there. But it's good to have you both on today. Erica, I'm hoping to kick things off with you. I'm hoping you can set the stage and introduce what are alternative strategies and how have really ETFs revolutionized access to these.
Yeah, happy to. So, what are alternative investments? That asset class it's a pretty huge asset class. It's very wide-ranging, and it would encompass things like private equity, like private debt. Both of those are, stocks and bonds issued by companies that are not listed on the public markets. It would also include real estate, infrastructure, commodities, and also hedge funds. So these types of strategies are sometimes integrated into portfolios either to help reduce volatility or correlation to broader bond or equity markets, or to help boost returns. So, Erin, until pretty recently, a lot of these strategies were not actually readily available to most investors. They were accessible only to large institutional investors like pension funds, ultra high net worth individuals, or accredited investors with over $1 million in investable assets. But a few years back, in January of 2019, there was an amendment to what's called the National Instrument 81102, which is basically the law governing investment funds, including mutual funds and exchange traded funds in Canada. And this provision essentially made it so that liquid alternative investment strategies would be accessible to all Canadians, not just hedge funds or higher net worth investors. A lot of new funds were created in the aftermath of this regulatory change. And these newer funds offered alternative-like investment strategies, but in a wrapper that allowed daily liquidity. And it used to be 2-day settlement on public markets, but now it's 1-day settlement. And this was rather than monthly or quarterly redemption windows for some of the more traditional alternative wrappers. So our long-short ETFs are an example of a liquid alternative strategy. I would even go as far as saying, Erin, that our long-short ETFs are a game changer for liquid alts because they democratize access, and they give your ordinary investors the ability to sell short within an ETF. So I would also want to call out and highlight that, with the long short ETFs, you have intraday liquidity, which means that you can buy and sell anytime during market trading hours. So like any stock or ETF, you have full transparency into the portfolio. So you can see a full list of all the names we own long in the portfolio and all of the names we're short selling. And these are updated always as of the previous business day's market close, so full transparency into the portfolio. I would also highlight that we do not charge any performance fees over and above the management fee. Most asset managers running long short strategies do charge additional performance fees, so that's a game changer as well. There's no additional paperwork or licensing required in order to access these ETFs. So these are really, points that I think are game changers for offering a long short in an ETF wrapper and set us apart on the marketplace here.
For sure. I love that game changer term. I think that's so true. And I think there's a lot of myths or misunderstandings that surround alternative strategies in the market. A lot of people think they're always higher risk. A lot of people think they're always higher fees. And I think we're going to bust some of those myths today as we
Hmm.
get into our
Yeah.
discussion.
So talking about
Um,
fees, I would just want to point out that our management fees are at 65 basis points or 0.65% on the long short strategies. And that's actually in line with our covered call ETFs.
Yes, very, very attractive fees for the amount of work that Lou and her team are doing on these
Yep.
portfolios. So let's get into our solutions because just over a year ago we launched the BMO Long Short US Equity ETF, that's LSLU, and the BMO Long Short Canadian Equity ETF, LSLC. So we have over a year under our belt now, but Erica, walk us through an introduction really in terms of how a long short strategy works and what it aims to achieve.
Yeah, so good idea. Let's chat first about what short selling is. Short selling is the sale of a security that the seller has borrowed. So the short seller believes that the borrowed security's price is going to decline, and then enabling it to be brought back at a lower price for a profit. So the difference in the price that they sold it for and what they would buy it back for would represent the short seller's gain or loss. But that's basically how it works. Traditionally, short selling was used by hedge funds and high net worth investors. Like I mentioned, most mutual funds in Canada until recent years were not able to sell short for regulatory reasons. And then with some of those changes in the law, like I mentioned earlier, mutual funds and ETFs are now able to take advantage of short selling as long as it's specified in the fund's prospectus and subject to certain limits. I should also mention that for an individual investor, in order to engage in short selling, your brokerage account actually has to be pre approved for margin trading so that you can borrow funds against the value of your margin eligible securities. So, margin trading is an investment strategy that is typically catered towards more experienced investors. You might have to meet some criteria in order to be approved for short selling. And with the long short ETFs, you don't have to go through those approval processes. You don't have to put up collateral in order to have that short exposure. So it makes it a lot easier to access that. So Erin, in a long short strategy, the portfolio goes long or holds long. The stocks, according to their analysis, have superior fundamentals, superior prospects, and they sell short the stocks that they feel have weaker fundamentals and a weaker outlook. So there's the opportunity, like you mentioned, as you were setting the stage here, opportunity to make money both on stocks in the portfolio going up and on price declines in the short positions.
Awesome. Great introduction. And Lou, I want to bring you in as the expert in terms of our mandates. I would love for you to walk us through what makes our process or your process and methodology unique in the marketplace.
So we really use a systematic approach here, which is very unique on the market. So I'll take a step back. So for long short strategies, as Erica says, really it goes down to stock pickings. You want to long the ones you think the stock will go up, and you want to short the ones that they're likely going down in the future. So in terms of our stock picking, we use very fundamental metrics to evaluate stocks. We look at the balance sheets and financial statements of a company. We look at different sectors. We look at different industries. We also look at the macroeconomics, how a company will face in the environment. But what makes us so unique is that we implement those metrics in a very systematic and quantitative way. So we would process a large amount of data in a very short of time. So we measure a very large pool of the stocks that we will select in the heartbeat of the market. So last but not least, we also optimize using our expertise to optimize the portfolio from a risk and return perspective. So to conclude, really, like our long-short investment process is systematic, responsive to market, efficient, and very sustainable.
That's great. Thank you for that. And I think if we go to the next, bring up the slide, we'll show a little bit of a snapshot of how our portfolio looks today. Maybe you can walk us through sort of that short exposure and what that looks like as well.
So now we can do a little bit deep dive. So as the chart shows, right, we try to stay close the sector weights to the benchmark weighting, while we be flexible on the ones that we think that we have our own views. Like for example, in ZLSC, which is our Canadian long short, we would overweight utilities, consumer staples, real estate, while we underweight materials and industrials as of September 30th. So next page, I would like to show like the long-short allocation on each of the sector. So here I want to have a very clear message here that we don't take big bets on any sectors, which means that we don't long or short the entire sector. We don't do that. So we would go down on each sector. We would evaluate all stocks within that sector and take long and short positions within that sector. So very similar approach and same approach for ZSU, which is our US long short. We from the chart you see we overweight industrials, real estates, and underweight healthcare and materials as of September 30th. And again, long short in each sector.
And how much of the portfolio is in short positions? Of 50 to 60%?
So we keep it as a range. So our short is between 40 to 60%. And our target, we try to stay close to 50 beta.
Okay, perfect. That's great. And Erica, we've mentioned our 1 year anniversary. We now have and can show performance data, which is really great because we don't just want to talk about the strategy. We want to show that it actually is doing what it's saying it's supposed to do. So talk to us about how it's performed over the past year.
So, Erin, these ETFs have done an excellent job. I would say that they've delivered returns in line with the broad equity markets, but with a volatility level that's more in line with fixed income. So, I would say that that's very notable. In terms of, we have the returns up on the slide here, and these are the returns up until the end of September. So the first 1 year returns for both the BMO Long Short Canadian Equity ETF, the ZLSC, and the BMO Long Short US Equity ETF, the ZLSU, and some pretty compelling numbers there in terms of cumulative net returns that you see. What I do want to point out, though, and what's really important, a reminder when you're looking at the performance of ZLSC or ZLSU, because these have a beta to the market of zero point 0.5, as we mentioned earlier, the S&P 500 or the TSX Cap Composite are not what you should be benchmarking these ETFs against. So because they're approximately half as volatile as the broad markets because of their long exposure and their short exposure, which takes away some of that exposure to the broad market, you should be considering these against more of a 50-50 mix of the broad equity market index and a money market or cash alternative ETF. So I would say that that's the more suitable benchmark to be calculating against. And when you look at it in those terms, I would say the returns are even more impressive.
And I would also add this actually make this product, this long short strategy ETF, a low to medium risk product because you're only half exposed to market exposure.
Low to medium. Okay, good.
Yeah. So many people thinking when you go into shorts, it's very risky, high risk. But if you're actually looking at the volatility of your NAV of this ETF, you're benchmarking with 0.5 beta, which is only half of the market exposure.
If I put myself in the shoes of a do-it-yourself investor, Lou, like there are risks involved in trying to do this strategy on your own, right? So that's part of the beauty of this ETF. And, at a relatively low management fee, you're getting the risk management that your team provides. So talk to us a bit about that risk management and the risks that you can sort of mitigate by going with an ETF for this type of thing.
Yes, I think the biggest risk we're kind of bearing on behalf of the investors is really like the short. risk, right? So as Erica explained previously, like, we borrow shares from the broker for the short positions. But there might be cases when the original lender of the share recalls those shares, there is no share the broker can borrow anymore. So in this case, we are forced to close out your short positions, which is the buying risk. Like you keep on the paper, on the media, people keep talking about like this type of situation happens. But the buying risk for short positions, right? You are forced to close the short positions when you don't want to. So we have multiple lines of defense here. So first, in our investment process, we only short easily borrowed names. So those names has a large number of shares available on the market. Secondly, we do not short heavily shorted names. So those means those are names have a very high chance to be kind of forced buy in. Okay. So we do have like very rigorous risk management process embedded that we are offering to the client.
Perfect. That's great to know. And Erica, let's close it off sort of in tying it into portfolio construction. How does an investor actually build a portfolio around this product, or how do they incorporate it into their portfolio?
Great question. I'm going to walk you through a couple of potential examples. So, Erin, in a traditional balanced portfolio, typically you'll have about 60% in equities, 40% in fixed income. Investors that want to boost their returns with this long short strategy can take 10% of that fixed income sleeve and allocate it to the long short strategies. A second example, Erin, would be investors that are more looking to reduce the level of volatility of their portfolios, and those investors can take 10% from their equity sleeve and allocate it to the long short. So that those are two examples of how they might be used in within portfolio construction. And I just want to wrap things up with a reminder on some of the key takeaways on these products. This long short strategy is a powerful tool that can either help you enhance your returns or reduce your level of risk. And as I mentioned earlier, the BMO long short ETFs are really game changers when it comes to the liquid alts asset class. So making the strategy accessible to all investors, it takes away a lot of the moving parts and the challenges associated with shorting stocks. And these strategies are no longer just accessible to those with over $1 million in investable assets. So I think that's a pretty powerful value proposition. You don't have to have a minimum $25,000 allocation to buy into these. You have intraday liquidity, you have full transparency and insight into the portfolio holdings, and the other part that I love to highlight again is there's no performance fees over and above that management fee and MER. So what you see is what you get. But like I said, really powerful tool to enhance returns and help reduce risk in the portfolio.
And if I may add to that, we are super proud for our first year's performance. And it's not by luck. It's actually like backed up by our very robust systematic approach in the investment process, which we believe is very sustainable in the future.
And for those investors who are considering a long short solution, like there are others available on the market. So do your due diligence. And, I'm confident that BMO's ETFs are going to come out on top of that due diligence process. Make sure you're looking at the ETF facts and really understanding those fees, because a lot of them do have those performance fees built in. And those might be, a little bit hidden. So definitely do your due diligence on this, but I'm confident that BMO's lineup of long shorts are going to look very attractive at the end of the day. Thank you both. Thanks, Erica and Lou. That was great intro into long short strategies. To anybody who's listening, if you have questions, put them in the comments below, or you can email us on etfmarketinsights.com. There's a questions box there that'll come right to us, and we'll get back to you as soon as we can. Thank you guys again for joining me. I hope to have you back again soon.
Thanks for having me on, Erin.
Next week, we'll be back and we'll be joined by finance creator or finfluencer, Brandon Beavis from Beavis Wealth. He's going to walk us through why he chose to adopt an ETF-focused approach in his portfolio, a change he made just within the past year, a reformed stock picker, if you will, and his view on asset allocation ETFs. So we'll get into all that next week. We'll see you then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.